If you own gold, silver, Bitcoin, or even just a stock index fund, what the new Fed chair has just done could either make or break your portfolio this year. Literally in his first meeting, he ripped up the playbook that Wall Street's relied on for like 15 years. $7 trillion vanished in a single day. Gold crashed, silver got cut in half, Bitcoin was cut in half, software stocks are tanking, and the people who panicked and sold, they locked in the worst losses of the decade right before the recovery started. So by the end of this video, you'll understand exactly what this new Fed chair is actually doing, why it terrified Wall Street, and the three-step framework that separates the investors who are about to get crushed in this new era from the ones who actually profit from it. My name is Felix Prehn. I'm an ex-investor and banker. This here, most importantly, is Winston, who's done all the research around here. And we've seen how this works from the inside. We also founded the Goat Academy, where my retired Wall Street mentors teach regular investors, and we've taught 20,000 students in the last 6 years. And this little channel here is about giving regular investors access to the knowledge and the skills that's usually taught only behind closed doors on Wall Street. So today, Winston here is going to show you why this one man's decision does change everything about how you might want to invest, whether you hold stocks, gold, crypto, silver, or just a retirement account. And put in the comments which one of those you're most excited about, or maybe which one of those is giving you most pain right now. Now, I warn you though, because this video is going to be pretty information dense. So Winston's also going to sit down and work very hard and put together everything I'm about to say, plus actually much more, and make sure this really lands for you into a free research report. You can download that for free. No conditions. Just go to felixfriends.org/crush, because a lot of people just got crushed. A lot more people are going to get crushed this year. Link is in the description down below, and it's yours. So grab it. So let's start with this new Fed chair, because if you don't understand this one man with the most power over your wealth in the world, you won't understand anything that happens next year. His name is Kevin Warsh. And he's not new to this. He was a Fed governor during the 2008 financial crisis. So he was in the room when the whole system collapsed, right? He saw what happened and the Fed panicked and started printing trillions. He saw the consequences. Now, the Fed has two jobs. It's sort of like two buttons in front of you. One, keep people employed, at least on paper. And button two is keep prices from going crazy, inflation. Now, the problem is you can really only press one of these buttons at a time. If you press the more jobs button by cutting interest rates and making it easier to borrow money, that can make inflation worse. It almost certainly will. If you press the fight inflation button by raising rates, you get less jobs. You can't do both at the same time. So going into this, everybody, Wall Street, the president, retail investors, we were betting that the new Fed chair was going to come in and smash that jobs button. I called him a poodle, right? I said he's the president's poodle. He's going to cut rates. The economy is going to boom. The stock market's going to boom. And we're going to be really happy. And that's what the president wanted, right? Trump basically said we should be paying the lowest interest rates of everybody on the planet. But the problem is with the Fed, and this confuses a lot of people, it's called the Federal Reserve. Now, it's not part of the federal government. The president can't tell the Fed what to do. What the president can do is appoint the chairman. So when the previous chairman's term expired, Trump appointed good old Kevin. Now, Trump also appointed the previous chairman. Yeah, the previous Fed chair was a card-carrying Republican, appointed Trump, lovey. Did exactly the opposite of what Trump wanted. And as Warsh walked in to his first meeting, he did the exact opposite of what everybody expected. First, he said, we're going to keep interest rates exactly the same. We're not going to cut them. And it wasn't a huge shock. People kind of expected that. But then he said this. There's this thing called the dot plot. It's sort of like a cheat sheet. Every Fed member puts a little dot on a chart showing where they think interest rates are going to be in the future. And Wall Street's done this and gotten used to this for the last 15 years. It's like a roadmap. It tells you what's going to happen to the stock market. It tells you where the economy is heading. Well, half of the people at that meeting said, we're going to get rate hikes. We were like, no, we want cuts. Trump promised us cuts. Literally only one person out of the 18 said there was going to be a cut. 1 out of 18, right? Complete reversal of what we were all betting on. And then Warsh did something that genuinely shocked Wall Street. He refused to put his own dot on the chart. The chairman of the Federal Reserve, the most powerful economic guy on earth, looked at Wall Street's favorite crystal ball and said, I don't like it. I'm not going to tell you what I'm going to do. And normally they put out this statement. It's fairly wordy, a couple of pages long. He cut this thing down to 130 words. 130 words is not a lot of words. All the hand-holding language, all the stuff that makes us feel good and safe, got rid of it. No more hints, no more guidance, no more, this is what we're going to do next. Basically, all he gave us was 6 words. The committee will deliver price stability. Nothing else. And then he also did something which Wall Street absolutely hate. He announced 5 task forces which are going to review everything the Fed does and how it communicates, how it measures inflation, how it handles the balance sheet, changing everything potentially. So he's ripping up the entire instruction manual. He's giving us maximum uncertainty. And what does it mean for you? Well, the simple version is this. The Fed's been a GPS for 15 years, hasn't it, Winston? Yeah, isn't he so sweet? And he said, let's get our GPS out and go in the mountains, right? We'll do that this afternoon, Winston. Told you every turn before you had to make it. We're going to cut rates. We're going to print money. Don't worry, we got your back, right? Now that GPS is just not function. It's just gone. So the Fed's safety net, what Wall Street calls the Fed put, the idea that the Fed will always step in to save the market when things got ugly, that may well be gone. This new chairman is saying, I'm focused on killing inflation. I'm not focused on babysitting your portfolio, your gold, your silver, your Bitcoin, your tech stocks. And it's the single biggest change for investors since about 2007, I would say. Determine what your portfolio looks like over the next several years. So here's the problem. The Fed is no longer going to hold your hand and tell you what's coming. How do you know when to act? When do you hold? When do you get out? And I know what's going through your head right now. You're hearing about gold crashing, silver getting destroyed, Bitcoin, tech stocks, Microsoft, all that stuff, right? And you're thinking, I was in those trades. I watched my account drop. I didn't know what to do. And if you're like most people, you probably froze. Or maybe you owned some big tech stocks and you gave back months of gains in just a week, right? Or maybe you're sitting on a stock, and if you are, put it in the comments down below. Are you sitting on a stock that's 20% down, 30% down, 40% down from where it was? And you're just hoping it's going to come back, right? Here's what I learned in about 20 years in this. The stocks that go up 1,000%, literally, most people still lose money on them. Not because they picked the wrong stock, it's because they had no exit plan. If it goes up that much, it's going to come down. Life-changing gains, really. Like, this would be a life-changing gain, right? So this would turn $10,000 into $100,000, which is pretty life-changing for most, right? If you agree with that, put life-changing in the comments. But people freeze. It's how our brain functions. So we don't know when to sell. And that's the mistake that kills every investor. Every single cycle. And it is completely avoidable. Wall Street has had a selling rule book for well over 50 years. And they never shared it with you. So what we're going to do here is we're going to give it to you. One live session, completely free. Whether you're a long-term investor or a momentum trader, the system will work for you. You learn exactly when to take profits, when to cut losses, and how to never watch that 10x return back into a loss again. So get yourself a free seat at whentosell.org. Whentosell.org, and show up live. Bring your questions. There's going to be no replay. Don't ask for one. I've ran this session once before at the beginning of the year. 17,000 people signed up for it. And it just showed me how big the problem is. And I'm getting these questions every single day. So this is one of those things you either show up for or you miss. Right? Don't count on a replay. Don't count on me running this again. But while you sign up for that free workshop, let me show you what actually happened to the gold, silver, and Bitcoin crash, and to some extent the tech crash that we're seeing, because most people get this wrong. Right? So gold, silver, Bitcoin crashing at the same time, and everyone's going, oh, it's the Fed's fault. Kevin Warsh, he said, you did this. But that is actually not the full story. there were three forces that hit at once. But first, a little context, because this matters. Gold had been on an absolute tear. It went all the way back past 5,500 or something. Silver went up to 120. Bitcoin was at all-time highs. Everybody was euphoric. Everybody was a genius. And that, right there, that straight up line is what should have been the warning sign. Because assets don't go up in straight lines forever. It's like a rubber band. You can stretch it and stretch it and stretch it, but eventually, if someone flicks it, it snaps back. And it hits you pretty hard in the face. And that's what happened. The rubber band was stretched to the limit. Kevin Warsh was the flicker. You did this to your rubber band and it hit you in the face. So why did they crash? Well, three reasons. One, it's what Wall Street calls the debasement trade. Now, what the heck is a debasement trade? Wall Street likes to come up with these terms to make themselves, sound smart. Basically, a bet against the dollar. So everybody was going, the dollar is going down. Trump said it. We can see it. It's happening. The dollar is losing value because of inflation and all the money printing. So you want to own things that hold value: gold, silver, Bitcoin, right? So for years, people have been piling into these because they were worried about the government printing as much money as it was, right? Bunch of lunatics. And then Warsh comes in and says, I'm not going to print more money. I'm not going to cut rates. I'm going to strengthen the dollar. I'm going to fight inflation, not be a surrender monkey. So the entire reason people were holding gold, silver, and Bitcoin, the weak dollar thesis, suddenly the most powerful economic policymaker in the world was saying he's working against it. Whether he is working against it is a different story, but he's saying it, right? Different things. You need to understand that. What people say, what people do, often very different. That's item number one. Number two is the opportunity cost. And people often don't think about this. Gold, silver, Bitcoin, if they don't pay you anything, there's no dividend, there's no interest, they just sort of sit there. You've got to pay storage for them. And, when your interest rates are basically zero, that's fine, because cash isn't giving you anything either, so you might as well hold gold. But when the Fed is saying we might increase rates, and you can now get 4%, maybe 5% from the government, a little bit more if you go into bonds, zero risk allegedly, guaranteed return if you believe them. So now gold and silver have to outperform, say, the 5% just to break even. And then you got storage costs and insurance costs, so maybe even a bit more. So the maths gets worse for the professional money that is looking at maximizing its returns. And then item number three, some of the fear went away. The tariff panic faded. We got used to there being another perma war in the Middle East, right? It's like, yeah, what's new? So all three things hit at once. That's why the pullback was so violent. Now, Bitcoin got hit even harder. Why? Because people buy Bitcoin with leverage, with borrowed money, sometimes 10 times, 20 times leverage, which means it goes down $1. Those guys are down, say, $10 or even $20. So it doesn't take a genius to work out they're going to get margin called pretty quickly. Now, I totally get that the gold and silver paper markets are not the same as the real world, and there is a supply deficit, there is industrial demand, there's all that story. It's still out there, that's all valid. But in the short term, even in the medium term, the price is set by the guys trading the paper. And that disconnect actually creates more volatility, more ups and downs, and those guys make money out of that. So the key lessons from this crash is what? Parabolic moves always correct. Always. It's not a prediction, it's just gravity. If you have a stock right now that's up, 50% or 100%, 1,000%, whatever, it's going to come down again. It's just a question of when and by how much. This crash was not a fundamental breakdown. Gold didn't suddenly become worthless. Bitcoin didn't stop working. Silver's industrial demand doesn't disappear. It's just the trade got a bit overcrowded. The run got parabolic. The Fed chair was the guy who flipped the rubber band. Okay, so here is what is actually useful. Because while everybody was posting panic videos and predicting the end of gold and silver and crypto, something else is happening. They started recovering a little bit. Not a huge amount, but we're 10% off the lowest price we've seen this year for, say, silver. Look at a Bitcoin ETF. It's again not exactly an exciting chart, but we are actually 6-7% off the lowest price. So why is that? Well, we're not believing Warsh as much as we did at the beginning, because the reality is the debt is too big for them to really hold interest rates high and not to print money. So he's now peddling this story that inflation risks have come down. And if you tell enough people and you tell them often enough, they might actually believe it, in which case inflation risks might actually come down. So he's playing it a little bit smarter. Second, we got really, really poor jobs data. Now, jobs data is about as reliable as, I don't know what, sunshine in London. So they added 57,000 jobs. Did they manipulate that data? I would not make such an accusation. I'm just saying all statistics are, there lies in statistics, right? I actually studied statistics. One of the things they torture you through when you do economics. But it means when you have less jobs, they are less likely to raise rates. So it's taken the fear off the table a little bit, because you raise rates, you destroy more jobs. So the market said, wait a minute, maybe those rate hikes aren't going to happen after all. And here's the history lesson that most people miss. And I want you to really pay attention to this, because this is the part that saves people money. The last time the Fed talked aggressively about raising rates was in 2022. And guess what happened in 2022? Gold got hit hard. Silver got hit hard. Bitcoin got hit pretty hard. Just to give you an idea, gold went down. Whoops, it's off the charts. It's literally off the charts. Let's see if we can make this a little bit bigger. Gold went down, 21%, for example. So it sounds kind of familiar, right? So you fast forward from today to right now, and we've got a crash. We've got pain. Now, after 2022, what happened? Massive recovery. I'm not telling you the same is going to happen to gold and silver. Past performance doesn't guarantee future results, but the pattern is worth understanding. Crash, fear, panic selling, recovery, new highs, right? That's kind of how it works. So we've seen this movie before. So what's the smart money saying? And I do actually mean smart money in the sense that they are the skilled money, because the major investment banks are run by people who've been trained by major investment bankers who have the skills to do so. They still have year-end gold prices that are 25 to 50% higher than where we are right now. They're not panicking. They see this as a correction within a longer bull run. So you sort of get, yeah, and then a little dip, and then, yeah, that's essentially what they're saying. The silver structural demand isn't going to go away anytime soon. The world is building more solar panels, more semiconductors, more electronics every year, so we need more silver, not less. It's a demand story. It's nothing to do with the Fed, with interest rates. And here's something else people are not telling you. This Fed chair is the most crypto-literate Fed chair in history. He's invested in crypto-related companies. He has advised crypto ventures. He's called Bitcoin digital gold for younger generations. But, and this is important, he's skeptical of altcoins. He's called them software pretending to be money. So what does it tell you? He's not anti-crypto, he's anti what I would call junk crypto. So there's a big difference there. So if you're a Bitcoin investor, that distinction should actually make you feel a little bit better. Maybe it doesn't, but should. And now let me share something else with you that I don't think you find anywhere else on YouTube. We have a system, I call it the Wall Street Protocol, because it's basically based on what the banks teach their employees. And it screens for stocks that are building a specific pattern. I call it it's kind of like a coiled spring, right? And when all the criteria line up, it flags a potential breakout. And I ran this screen on every single major gold and silver miner. There are about 50 major gold and silver miners. And guess what? The result? Zero. Not one qualifies. Every single miner is 20 to 60% below recent highs. The entire sector is in pullback mode. And that might sound like bad news, but it's actually incredibly useful. It tells you don't chase the bounce in miners right now, wait for the setup. At least that'd be my opinion. I'm not a financial advisor, I'm just giving you my opinion, right? So what are we watching for? We're watching for overall industry strength. And we're just not seeing that right now. So when I make a video, and I did one I think last year in April, and I said, I'm really liking gold miners right now. And, well, where were we? We were, there's 2025, we were here, somewhere here, right? And then gold went on an absolute massive tear, right? It went up 100% gold miners, plus individual gold miners went up a lot more than that. And then it goes down. And all I'm saying to you is, that is the pattern that the market lives in. This is the system, how it's meant to work. It's just we haven't been taught it. And because you haven't been taught when to bloody sell, you lock in the 100% gains on paper, you tell all your friends how clever you are, you feel wonderful, and then you wake up one day and you go, why am I 35% down? This feels terrible. And maybe you bought at the top because you bought the news cycle rather than the can change that. We can literally teach you in about an hour and a half the very rules of selling. And I'll do that if you join me on Saturday night. That's Saturday evening New York time. So this coming Saturday. Whentosell.org. It's down below in the description if you want to get yourself a free ticket for that. As I said, last time we ran this, 17,000 people signed up for that. And there's value in having that systematic approach instead of just guessing. Well, for once, you don't need to worry about stuff anymore. And for twice, that was the sentence, you would not be experiencing massive losses ever again. So I've just given you the new fetcher, the crash, the recovery. That's the what. Now let me give you the so what. What do you actually do with all of this information? So I'll boil it down into just 3 steps. You can reuse this regardless of whether you're in gold, Bitcoin, tech stocks, index funds, or just a retirement account. This works in the Warsh era, and it would have worked in every previous era too. First, accept the new rules of the game. The Fed is no longer your co-pilot. For 15 years, investing was like driving with a GPS. The Fed was basically telling you what it was going to do. Now the GPS is off. Now, that sounds a little bit scary, and for a lot of people it is, but there's a flip side to that. The old system favored Wall Street. It favored the big banks. They had teams of analysts whose entire job was to decode Fed signals. They have algorithms doing it ahead of everybody else. Regular investors, we were always a step behind. And the new system, nobody has that edge anymore. So there are no signals to decode here from the Fed. So everyone's working with the same information, which means more opportunity for people who have a plan. And then step 2 is upgrade what you own. Quality, quality, quality. Think about it like this. If you buy a house and it's made of cardboard and the weather is perfect, it's fine. It's cheap, it's fast, nobody cares. But in a storm, you kind of want a brick or a concrete house, right? There are lots of companies out there that are zombie companies. They borrow at near zero rates and it works. Now rates are 3-4%. It's going to be tough for them. And then most importantly, learn the sell rules. It's literally the one thing that separates pros from amateurs. And I'm not saying that to be kind of harsh. I'm saying it because I've watched it destroy people's portfolios for many years now. I've looked at thousands and thousands of our students' portfolios. A lot of them come to us because of the pain of having something that's down 30, 40, 50, 60, 70%, even 80%. So some of you have a buying strategy, right? And it might be, I like the stock, it's in the news, my buddy told me about it, I buy some. Okay, not perfect, but it's a sort of a strategy. But what's your selling strategy? And I normally get a blank stare. I'll hold it, I'll set a random stop at a random percentage, or I'll sell it when it's up 30% or whatever. It's not a strategy. It's a sort of a prayer. And when you live in a world now where there is no more guidance from the Fed chair doesn't tell you what he's going to do, you're going to get more up and downs. Your stops are going to get hit more if you have them. If you don't have them, well, you're really in trouble. So the cost of not having selling rules just went through the roof. And every institution on Wall Street, guess what? They have selling rules. Every hedge fund has selling rules. Every trading desk has a sell rule. When a position hits a certain point, they cut it. When it hits a certain profit target, they take some off the table. It's a mechanical, emotional, planned in advance process. And the best investors I've ever worked with all had one thing in common. They decided when they'd sell before they bought it. They realized that buying a stock is just the beginning. Buying an index fund is just the beginning. The exit was the plan. And this applies whether you're a trader or you're an investor, gold, Bitcoin, tech stocks, whatever is your flavor. It's all the same thing. The discipline is always the same. So everything I just walked you through, the crash, the new Fed share, the recovery, the framework, none of it matters if you don't know when to get out. I've literally watched people hold through a crash praying it comes back. I've watched people panic sell at the exact bottom, the day before it started recovering. And it doesn't have to be like that. So I'm going to run this free session for you, completely free, where I walk you through the exact selling rules that my Wall Street mentors taught me. I didn't make these up. Same rules institutions have used for over 50 years and never shared them with retail investors, because why would they? So whether you're a long-term investor or a trader, gold, silver buck, the system is the same. So go to whentosell.org, grab yourself a free ticket, show up live, and write "see you Saturday" in the comments down below, and I'll see you there. Bring some questions about things that you got going on in your mind right now. And if you're going to ask for a replay, no, there won't be one. So what have we covered? The old rules are out of the window finished, finito. Quality is where I would want to be, and I would want to have selling rules, which I do. Every single thing I own has a sell rule attached to it, and it's why I'm happy, no matter what the market does and throws at me. There is always an opportunity, but it is something that requires a plan. And I think the people without a plan, who've been conditioned and gotten used to, well, everything goes up in a straight line more or less for quite a long time now, that might be changing. And you're going to want to know how the money is moving around and when you might want to be moving your money out of stuff that's up a lot or that's starting to go down a little. So come along with us. Winston will be there, whentosell.org, and if you got some value out of this, share this video with somebody who might get some value out of it too, and maybe somebody who might need a selling rule. Send them that link, whentosell.org. I'd appreciate that. And it'll allow us to just spread more financial education to more people, make a bigger impact. I thank you for watching. Gold just had the worst quarter in over 10 years, and I'm joined by Clive Thompson to guide you through our views of where we see gold and silver going, the opportunities and also the